In this session, let's try to understand some basic numerical procedures which play an important role in the valuation of derivatives and especially the valuation of options. Right? Three major kinds of numerical procedures is what we are going to look at. However, what are the important things that we are going through in this session? We will understand binomial trees as one of the important tools which uses numerical procedures to evaluate the find of the value of the derivatives. So I can use the concept of binomial trees for options on indices, for currency based options and futures based options. Then if I have to apply the binomial model for a dividend paying stock, because in general we work out the binomial model with the non-dividend paying stocks. So if I have to extend that binomial model to a dividend paying stock, how do we look at it? Are there any alternative procedures apart from what the Cox, Ross, Rubenstein model, which has been the traditional, the binomial tree model? Apart from this model, are there any other alternative procedures for constructing the binomial trees? Then, how do we look at the time dependent parameters, the values which change with respect to time? If the volatility changes with respect to time, how am I going to look at it? Then the second of the numerical procedures. So up to here I am looking at the first numerical procedure, which is the binomial trees. The second of the numerical procedures which we are going to focus on is the Monte Carlo simulation, and the third one we will focus on the finite difference methods. So these are the three major aspects which we are going to discuss as a part of the numerical methods. So what are these numerical methods? First thing we have to understand, in many cases we may not have the formulas like the Black-Scholes for valuing the derivative. And we know that the formula like Black-Scholes, it makes a lot of assumptions relating to the stock price movement. Stock price follows a log normal distribution, or it makes an assumption that the volatility is constant. So only when there are so many restrictions that are applied, I can use an analytical result like Black-Scholes formula. So which means in reality, there may be a lot of situations where this analytical results may not be applicable at all. In that case, we are talking about solving the value for those derivatives using a set of numerical procedures, especially where the analytical solutions don't exist. And as I have already mentioned a while back, the three methods that we are going to look at are the trees, the Monte Carlo simulation, and finite difference methods. When it comes to the trees and finite difference methods, they are generally used for valuing American options because we can create trees. So they are very comfortable to value American options and other derivatives. The main thing is where the decision has to be made prior to maturity. Right? What does that mean? In American option, I can take an exercise decision even before maturity, or probably a Bermudan option where there are multiple points per exercise. So different kinds of option where the decision has to be taken before the maturity date itself, we can very well use the trees and the finite difference methods. But when it comes to Monte Carlo simulation, the good thing is when the payoff is dependent on the history of the underlying, From the past prices, if I have to take a decision, especially if you recollect the Asian options, where the payoff is purely based on the average of the prices over the life of the option. So there is a lot of dependency on the history, on the path that is typically being followed. So where there is a possibility of such a kind of stuff, or even when there are more underlying variables instead of just one or two, if there are multiple underlying variables, then still compared to the other procedures, Monte Carlo simulation becomes more and more handy. And all these three methods can even be comfortable not just for computing the value of the option, but they can play a role even in the computation of the Greeks as well. So let's try to understand each of these three methods one by one. So getting started with the binomial trees, we have understood the concept of binomial trees quite comfortably. So this is where I'm quickly running through, because we have dealt with the concept of binomial trees earlier. They are used to either value the European options or American option. What we typically do is the whole life of the option. Let's say this is a 3-month option. So we split the life of the option into various time intervals. Right? Probably if I'm talking about a one-step tree, then probably the entire 3 months is one single time interval. But if I'm talking about a two-step tree, then it is like 1.5 months per each step. So if I go with a 10-step tree, then it might so happen that 9 days could be each step. So likewise, I can create even a 90-step tree where I'm talking of 1 day as one time step. So I divide the life of the option into a large number of small time intervals of length delta t. So here the delta t is 1 day, here it is 9 days, and so on. And in each interval, I look at the two moves for the underlying asset. Either it can go up to SU or it can go down to SD from the current price of S. And SU, we always call it as, probably if I am saying S naught is the current price, we generally define it as S naught multiplied by U, which is an up factor, and SD we'll call it as S naught multiplied by D, which is a down factor. So we always see that U is greater than 1 in general and D should be less than 1, because this should talk about a fall compared to the original. This should talk about a growth compared to the original. And then we'll talk about an up movement in the price as well as the down movement for each small time step. And we also talk about the probability that it goes up as P, and 1 minus P we define the probability that it goes down. Right? This is what we do as a part of the binomial tree based valuation approach. Then we apply the concept of risk neutral valuation. So the concept of the risk neutral is purely, it assumes that the world is risk neutral. Means the investor does not expect a higher return for any kind of risk that he is taking. So all he is expecting is a risk-free interest rate itself. Right? The expected return from all kinds of assets is the risk-free interest rate itself. That is what is the fundamental behind the risk-neutral valuation, which means at every stage I find out the expected value of the payoff, the probability multiplied by the payoff. The probability multiplied by the payoff, I'll get the expected pay value of the payoff here, and I discount it to the present value at the risk-free rate of discount. Now this is what typically goes as a part of the valuation using the binomial trees. So some of the things which we have dealt with earlier, if I want to find out the up factor, we take e to the power of sigma root t, down factor goes as e to the power of minus sigma root t. And based on these two, we compute the probability of going up, which we take as e power r minus q t minus d by u minus d. So this part we even sometimes call it as a. E to the power of r minus q delta t, we call it as a, and this is a formula which we generally use to do the risk neutral valuation associated with the binomial tree model. Now just a quick recap. We make some assumption of u equal to 1 by d, means the up factor is 1 by d times the down factor. This assumption will result in a recombining binomial tree, where the number of possibilities at the nth tree, they become only n plus 1. Number of possible values of the asset at the nth tree will become n plus 1 rather than 2 power n, which makes the computation much more difficult. So we make an assumption that u equal to 1 by d. So we will take different time points. I times the delta d, if I am taking, will get I plus 1 asset prices, just like this I am talking of. So if I want to know the third step, at the third step I'll get 4 different nodes, and at the nth step I get n plus 1 nodes in case of a binomial tree, and we get the asset prices purely following the binomial distribution S naught. Now if you look at this, this is S naught. Okay, this I call it as S naught U, this I call S naught D. Now if I look at this next chain, it becomes S naught UU, which is U squared, and this becomes S naught UD. U is 1 by D, so this becomes S naught, and this becomes S naught D squared. Now if I look at one more there, it becomes S naught U cube, then it becomes S naught U squared D, then it becomes S naught UD squared, and S naught D cube. If you look at this, this is nothing but an expansion of something like this. S naught U to the power of J D to the power of I minus J, where J is landing from all from 0, 1, 2 up to I. Now if I equal to 3, then it becomes S naught U to the power of, if I is 3, I'll take J from 0, 1, 2, 3. Right, j will become 0, 1, 2, 3. So if j is 0, it becomes u to the power of 0 d to the power of 3. Then if j is becoming 1, it becomes u to the power of 1 d to the power of 2. If j is 2, then this becomes like this, and if j is 3, this. So these are the values that I am getting for the possible stock price. So even I can directly remember the way of movement of the stock price using this kind of a form as well. And we have also said that the tree recombines because we are making up movement related with the down movement. So an up and down is same as down and up. Whereas in reality, if I don't make it recombining, or if I don't go with this kind of an assumption, I may end up with 2 per n values for the stock price at the nth node. So the up movement followed by a down will be the same as down movement followed by an up. That is what we call as a recombining binomial tree. Now what do we do when we work in terms of valuing the option using the binomial tree? I work backwards throughout the tree. So I look at the end of the tree, S naught U, S naught D, S naught U squared, S naught D squared. Now let's say if it is a two period tree, two-step tree, I evaluate by starting at the end of the tree. So I start here, work backwards. So I know the value of the option, because if the option is a call option, at each node I will work out what is the payoff. If it is a call option, I'll talk of maximum of the stock price minus the strike price, comma 0. So at each level I calculate that. I know the probability of going up, I know the probability of going down. So at each node I find out the expected value. So here I find the expected value, here I find the expected value, because I know the option values at time t. Then I find the value of each node at time t minus delta t. Now I'll find the value here, I'll find the value here. I get the expected value here based on the probabilities, right? I take the expected value at time t and I discount it by the rate r for this time period delta t. So I'll get the value at t minus delta t. This is t minus delta t. The same logic I'll apply here. I take the expected value, I discount it by r for a time period delta t, I get the value here. Now, depending on whether the option is American or European, if it is European, again I follow the same procedure. This is the value at time t minus delta t. This is the value at time t minus delta t. There is a p probability that this is the value. There is a 1 minus p probability that this is the value. Then I go with again the expected value and again discount it to the period t minus 2 delta t. Here t minus 2 delta t is same as the time 0. So I discount it until that part till I come to the time 0. But when I am talking about an American option, apart from looking at the present value of the expected value at time t, I also look at the process of what is the value S naught u minus k comma 0, which means if the option is exercised at time t minus delta t, what is the value? If the option is taken up to time period t, what is the value? Whichever is the maximum, I am going to take that. So if the option is American, I check at each node whether the early exercise is preferable compared to holding it till the next period and next period. So that way I work backwards and finally we are getting the value of the option at time 0. That's a simple way we operate using the binomial tree based approach, right? Let's take one example which we can quickly solve using this binomial tree approach. Okay, consider a 5-month American put option. American put. The time period we are talking of 5 months, so I'll convert it into years. On a non-dividend paying stock, the stock price is $50. Strike price is also $50. Risk-free interest rate is 10% per annum. Volatility is 40% per annum. Fair enough. Divide the life of the option into 5 intervals of length 1 month. So delta t for me is 1 month, which is nothing but, right, probably I'll say number of intervals. I'll find out the number of intervals being asked is 5. So from here I get my delta t as 1 month, which is nothing but this number divided by 5. I get it as 0.08. So this is how I have to construct my tree. Okay, so this is American put option. So we'll first create the stock price tree. Stock tree for the American put, right? So let me start here. Initially I'll take the stock price. Then I require a few things. The up factor, which comes out as e to the power of sigma square root of t. So e to the power of sigma square root of the delta t, which is this one. So I'll find out the up factor. I get it something like this, and the down factor, which is d, I can take it as 1 by u. So I get this as the down factor. Then I can compute the probability of going up, which is e to the power of r minus q times delta t minus d divided by u minus d. Now here I don't have q because it's a non-dividend paying stock. So I'll take it as e to the power of r delta t. So that I can very well find a first of all. A is nothing but e to the power of r delta t for simplification. So e to the power of r times delta t works out to be a. Now from here I'll compute the p, which comes out as a minus d divided by u minus d. So this gives me there is a 50.7% chance of going up. So from here I can say the remaining probability of going down 1 minus p works out to around 0.49. Fair enough. Now we are bringing in a stock price tree. So we'll create an up movement. So from here, if I'm starting to create an up movement for the 5 periods, so I'll say this number multiplied by the up factor. The up factor, we have got it as 1.12. So this came here. I can take all the things up. Okay, let me put the dollar. Okay, let me take it up. So this is what is going to happen over the 5 periods. Now similarly I can put the down factor. So this price multiplied by the down. Alright, so I am getting it over the entire 5 periods. Right, so this happens to be the down. And now either I can take the ups, because ups or downs remain more or less the same. So what I can very well do, I can repeat the same for all the ups, right? So these are going to be the ups at every stage, and they can result even in the downs as well. So these are the 5. Okay, this is at the end of 1 period, 2 period, 3, 4. I also require the 5th one as well, because this is the price as of now. Right, so let me do it up to the 5th period as well. So I'm going to construct the tree across in this way. So my binomial tree, which is a 5 period tree, came up. So this is like, so I can very well mark this as t equal to 0. Right, if I'm looking at the time period, I'll call this as 0, 1, 2, 3, 4, 5. Right? So this is my first step. I compute the stock tree like this. And then we are talking about this being the strike price. So we'll create the option. So here we are talking of American put. So what we'll do is the same thing, or probably let me take this here so that we can demonstrate side by side. Okay, let me take the American put here. So let me start. We require 6 columns, 2, 3, 4, 5, 6. So let me start here where I'm looking at the payoffs. So I'll start with the end period. I know that the payoff of the put option is the maximum of the strike price minus the stock price, comma 0. So this is where I'll say the maximum of the strike price, which is this much, minus the possible stock price, comma 0. Okay. So in the period 5, let me again repeat the periods here as well. In period 5, if the stock price goes to 89, the option becomes worthless, so it is having a payoff of 0. The same way for all the different possible prices, I'm taking this situation, right? So these are the payoffs that are possible. Agree? Now, I know the probabilities of going up and going down. So that's where I take the expected payoff. So for all these, I would like to take the expected payoff, which I'll take it as the probability of an up movement. This is the probability of up movement. I multiply it with the up price plus the probability of a down movement. I multiply it with the down payoff, which will give me here it's 0. The same logic I'll implement across all. So here this is my payoff, here this is my payoff, here this is my payoff. Now across I got the payoffs, expected payoffs at time period 5. Now I'll get the expected payoffs at time period 4. Expected payoff at time period 4 by discounting it with e to the power of r delta t. Okay, I'll discount it this by e to the power of r and delta t. So I have discounted this, got a value of 0 here. The same logic, I'll take it further. Yes, here it is, and here it is. So these are the present values of the future, the expected payoffs at time period t taken to time period t minus delta t. Now because it's an American put option, along with this, I'm even supposed to check what if the option is exercised here. So apart from this number, I would also look at the maximum of either this number, or if the option is exercised at any of these prices, which is nothing but the strike price minus the stock price at this particular moment. I'll look at whether I take it to the next period or I exercise it at the current period itself. Whichever is the one that is having a higher payoff, I'm going to look at that particular option. So that's the reason we are going with the maximum of these two, which in this case is still telling me that here it is 0 itself, here it's 0, but here it is 2.66, still it is 2.66. 9.89 now has become 10.31. It says that if the price has come here, rather than going to the next period, you can very well exercise it in the current itself. Even for the last, there looks like some kind of a change. And once I have this, again the same logic, I can find out the expected value by doing the probability of going up and down. Across the space, I can compute the expected values. Now for this tree, I got the expected value. Now again the same logic which I have used, finding the maximum. Finding the maximum is something which I can still do. So here I am trying to find out the maximum values across each of the nodes. One, looking at whether I should exercise it or I take it to the next period. So whether I should exercise it or take it to the next period, again we are doing similar kind of an action. Then once I have done it, Then again it's the process of finding the expected values at each of the nodes. Now the process is getting simply repeated. Again, once I have found out this, I can very well manage out finding out the maximum at the previous block again. Should I take it to the next period or should I exercise it there itself? Now I am finding out the present value and I am trying to do the comparisons again there. The same logic again continues. I am taking the expected value at time period 2 based on the probability of up and down movements. I have taken the expected values. Again bringing that to the time period 1, whether I should go with the present value of the period 2 or exercise it at period 1 itself. Now this is what led me to these two things. Again the expected value at time period 1, and finally I could even think of bringing it down to the current value, which talks about 4.48. Now this what works as the price of the American put option. Instead of extending it to the next time period, if I keep executing, so at each time step we are trying to assess what is the value if the process goes to a time period t, what is the expected value of the payoff versus if it gets exercised at time period t minus delta t, what is the expected value of the payoff, and that is what is executed backwards till the last, which is what is resulting in the price of the put option. So here is what I'll say, using this binomial tree model, this is what is the price that is associated with the American put option, right? And now with this same American put option in place, how can I compute the Greeks? First, if I want to look at delta, I know delta is nothing but the change in the price of the derivative divided by the change in the price of the underlying asset. So from this model, how do I compute F11 minus 10? So this is the price of the derivative when the stock has gone up. This is the price of the derivative when the stock has gone down at time period 1. So at time period 1, I'll say that the delta, right? I'll take the delta at time period 1 as F11 minus 10. 11 probably here, 12 here. So this is the change in the option price when the stock price has changed from this to this. So the stock price 56.44. When stock price is 56, the delta is the put option value is 2.16. When stock price is 44.54, the put option value is 6.95. So the delta is saying minus 0.41. The same logic I can do for time period 2. Again here also I can take, okay, this is the price of the put option minus this is the price of the put option, or probably I can take it the extremes itself. I can take even the extremes. This is the price of the put option when the stock has gone down. This is the price of the put when the stock has gone up. So the stock has gone down to here, the stock has gone up to here. So the delta has come out to again minus 0.4174. Here, what is it? This minus this. This is what is the change in the option premium for a change in the price. So again minus 0.41425. Here also if I look at this minus this divided by this minus this. So here it has come down to minus 0.38, and for the final period this has come out to minus 0.35. So these are the ways in which I can compute the delta for each of the period. Then if I am looking at theta, easier way. Okay, let me compute theta. The easiest way to look at theta is when all others are remaining constant, which means the stock price has to remain constant. So I cannot do the theta for time period 1, I'll look at it with the time period 2. So that is where we say F21 minus F00 divided by 2 delta T comes out to be my theta. 2 delta T. Right? So my theta, if I am looking at this particular period, I will take the price of the option here when the stock price is 50, again here when the stock price is 50. So I'll take the difference between these two, and I'll talk about the dividing of this by 2 into delta T. Delta T, we have got it, which is this, which gives me that the theta is minus 4.3. If I go with this kind of a mechanism, if I go with binomial tree mechanism, this is how I compute my theta. Then if you are looking at the computation of gamma, right, using the gamma, all we are saying is I'll take h first of all as 0.5 times s naught u squared minus s naught d squared. So for that, first I'll compute my h, which is 0.5 times s naught u squared, so which is this much, minus s naught d squared, which is this much. So my h is around 11. Now what I do is, for computation of the gamma, I'll take two directions. F22 minus F21. I'll take the delta with respect to this. Right? I'll take the one delta with respect to this. I'll take another delta with respect to this. Right? I'll take one delta with respect to okay, let me look at the two deltas here. The first one we are saying, okay, the change in the stock option price from here to here when the stock price has changed from here to here. So this is what is coming out as my first delta. Then second delta is talking about the change in the option price from here to here for a stock price change from here to here. So this is one more. Now what we are saying is I take the difference between these two, 2 minus 21, which is this number, right, 2 minus 21 s naught u squared by minus s naught. Okay, look at it like this. Let's compute it like this. The delta 1 is coming out, if I am looking at the time period 2, f naught 20, right, if I am assuming something like this, s naught u, s naught t, s naught u squared, s naught d squared, right? Now here if I say this is f21, f2 or f20, f21, f22. I'm talking of f21 minus f20 divided by s naught minus s naught u squared. This is one delta. Then The other delta we are talking of F22 minus S naught minus F21 divided by S naught D squared minus S naught. So these are the two deltas, right? So these are the two deltas. I am interested in again the change in the delta. The percentage change in delta is what I am looking at, right? This is one delta, this is the other delta. So it's actually coming out as F21 minus F20 by S naught minus S naught U squared minus F22 minus F21 divided by S naught D squared minus S naught. This is the physical change, but I require the per change in the underlying. So that's where I am taking the H, which comes out as the half of the actual difference between the up movement and the down movement. So here I get my gamma as nothing but the difference between the delta on one side minus the delta on the other side divided by the H, which gives me that the gamma is around minus 0.03. Or if I take it the other way, I get the gamma to be around, because I am looking at up and down. So here I will get the negative, which is the down and the up. So I am getting a gamma to be around 0.03 depending on whether I am going for a long or a short position. So this is what we take into the computation of gamma. Then if at all I have to go with the vega, directly from here I can't compute the vega. All I have to change is I have to change the sigma a little bit and finally do the computation of the price. Probably instead of 40%, what I can do is, okay, when it is 40%, this is the price. When the sigma is 40%, let's say this is the price of the put option. Now I change the sigma a little bit, probably 40.1%. I say 40.1% and I say this is the price of the put option. Now this is where I can look at when the sigma is 40, this is the price. When the sigma is 40.1, this is the price. Now I can find out the vega quite comfortably. The change in the price of the option divided by the change in the volatility of the option. So here the vega comes out to be around 13.12. So this is how we can compute the vega, but not that directly. And I'm getting the price of the option in both the cases, and I'm dividing it by the change in the volatility of the option, right? All right. Now, can I use the binomial tree for other option? The earlier example that I have looked at has used the binomial tree for a stock on which no dividend is paid. But here we can see that we can apply the binomial tree over a stock index, which is equivalent to providing some kind of a known yield, R minus Q. Q is what is the dividend yield that we are expecting on the index or the portfolio that is underlying the index. Similarly, when I am doing it with the currency options, again I expect that they provide equivalent to some asset that is providing a known yield, which is equivalent to foreign risk-free rate of interest, which is RF. And similarly, when I am looking at in case of options on futures, I can expect that to be equivalent to an asset that is providing a known domestic risk-free rate of interest as the yield. So probably here my A value, which is e to the power of R minus Q times delta T, here it will be like this. In case of currency, we call it as e to the power of r minus rf times delta t. Whereas in case of futures, it becomes e to the power of r minus r times delta t. That's where we make it equivalent to 1. So our p value, which is the probability of up movement, we always talk about a minus d by u minus d. U and d remain the same. Only the a changes to one of these three values. So the probabilities of the up and the down movements will change. Rest all calculations are going to be the same. Right? Probably I'm not taking up these examples, but look at it. A 4-month American call option on index futures where the current price is 300. So S naught is 300. I'll take the T as 4 months, which is 1 by 3 years. Okay. Exercise price is 300. Risk-free rate is 8% per annum. Volatility is 30%. So the life of the option is divided into 4 1-month periods. So the delta T, I'll take it as 1 month, which makes it 1 by 12. Right? It is not mentioned anything regarding the dividend yield, but generally we'll have something related to the dividend yield. So that you subtract it. Let's say for this example, assume that the dividend yield is 2% per annum. Then you make the R as around 6% per annum and do the same thing as we have done for any kind of a call option, binomial tree for a call option example, right? Then consider a 1-year Euro American put option, T is 1 year on pound. Current exchange rate is 1.61. The strike price is 1.6. US risk-free rate, if I look at it from a US perspective, it is domestic. Sterling risk-free rate RF is 9%. Volatility of the exchange rate is 12%. The life of the option is divided into 4 3-month period. So delta T will become 0.25. Find the value of the option. Now here we will be considering A as e to the power of R minus RF. RF is 9% times delta T. So that is what we'll use for constructing the up movement as well as the down movement and the probability of up and down, which is what goes into the pricing of the option. So we can quite comfortably use the binomial tree model for finding out the prices of other options like stock index, currency and futures as well. Now, what about the stock which pays dividend? We have said that we can use it for stock index, for currencies, for futures. But can I use the model for dividend paying stock? Now, just to understand the concept, dividend, whenever a company pays, it reduces the stock price on the ex-dividend date by the amount of dividend that has been declared. So to model it, a few things. If I know the dividend yield, straightforward, do it as good as a stock index. R minus Q. So R minus Q times delta T, take the Q as the dividend yield and similarly do the procedure as I have highlighted in the earlier slide. So the other way is, instead of taking this dividend yield on a continuous basis, see, if I do it for an index, it is much okay. The reason being, every day some stock or the other pays the dividend. So you find that dividend is paid almost every day in some numbers or the other. So if I am assuming the continuous dividend yield, in case of index, it is more and more reasonable. But if I want to assume the same for a stock, it goes slightly away from reality, assuming Q on a continuous basis. Now this is where we can think of assuming the dividend yields on a discrete mode. Now, when I am doing this assumption of the dividend yield on the discrete mode, all I am making is initially I calculate U, D and P without dividends, right? But at that particular point, when the stock is going ex dividend, from there I keep reducing the stock price. Now here, okay, up to here the stock price is fine. But if I say here there is going to be a dividend of that much that is going to be declared, the dividend yield, let's say of 1% is going to be declared. Now what we are going to do is, from here onwards, we are going, so this particular point, let's say I multiply it by 0.99, saying 1% is the dividend yield. Right, I multiply this across by 0.99, saying that this is the dividend yield. 1% is what is going up and this is what is the dividend yield. I've taken out this to be the dividend yield, and finally it resulted in the price of the American put option changing accordingly. So which means actually what has happened, the tree is going up like this, tree is moving like this. The moment I am seeing a dividend here, the price got dropped up to here, and from here again we are talking of up and down movements. The price has dropped here, and from here we are talking of up and down movement. Now this is where we are working out, especially when there is a dividend yield which I am taking it in a continuous basis. Right, when I am taking of the dividend yield on a continuous yield kind of a basis, this is I'm taking the yield at discrete intervals. This is what I can work out for the finding out the price of the option. But when I talk about a known dollar dividend rather than a percentage dividend or rather than a yield, if I know that this company is going to pay a dividend of $3 or $2 at the end of 2 months, then what happens is, at that price the stock price reduces by, let's say, $1 or $2. Then after that you don't find the tree is recombining. The number of nodes that have to be evaluated, they increase drastically. You may have to go up to 2 per n nodes because we don't get a recombining kind of a tree. And if there is one dividend, fair enough. But if there are several X dividend dates, even complication is going to come up, because every place I have to reduce it by that much and it becomes a tough. Now this is where we talk about, in that case the better way is, whatever is the present value of the future dividends, you take the present value of the future dividends, subtract it from the current spot price, make it as the updated stock price, compute the modified volatility of the updated stock price, right? You can make an assumption that the actual stock price is more or less similar to the updated volatility of the actual volatility of the actual stock price might be equivalent to the volatility of the updated stock price. You can make some such kind of an assumption, but take the updated stock price, take the updated volatility, and based on that do the construction of the entire binomial tree. If the dividend is known to be a yield, then probably at that particular period when the dividend is declared, you can work it out. But if the future dividend is a known dollar amount rather than a yield, we cannot rely heavily on the discrete, reducing the stock price at that particular point, because the tree will get translated into a non-recombining tree and the binomial tree becomes pretty much painful in terms of evaluation. So the better solution looked at is find the present value of the expected spot price, use that as the spot price. Similarly, find out the modified volatility, use that as the sigma, and then go ahead in terms of valuing that option using the binomial tree approach. So these are the two things that we have to keep in mind when you are trying to do the valuation of option on a stock that pays some amount of dividend. And here we even talk about an important technique called control variate technique, especially for increasing the accuracy of the American option. A good thing. Now what it says is, okay, you find, here we have taken the example. Here we have found the price of the American put option, right? Now I got the price of the American put option as 4.48. Now for the same example, I'll find the price of a European put, right? For the same example, I'll find the price of the European put. All I have to do is I don't need to compare at the previous stages, right? So these things for the last, I'll keep them as it is. Okay. So here I'll find out the max of the strike price minus the stock price. So this works out to be my strike price, okay, let me do it, minus the stock price, comma 0. So I am working it out across, right? Up to here it's fair enough. Then I'll find the expected value, which I think expected values I can take directly from here. So I'll take the expected values. Alright. Now all I require is I find the present values, which is nothing but this number divided by e to the power of RT. R and a delta T. Alright. So I got the present values here. So here I don't compare the option getting exercised at that particular point because this is a European. So the next again I'll take only the expected values and I go ahead by taking the present values. I go ahead taking the present values, I don't compare them anywhere. Then again the expected value. Then again the present value. Then the expected. Then the present again. Expected. And finally the present value. Now the corresponding European put option, the price of it is coming out to 4.31. The American, so let me use this. For the American, I got it as 4.48, whereas European, I got it as 4.319, 4.488. Right, so these two are the ones. So I am using the same tree both for American as well as European. So I got this FA is the price of the American option, FE is the price of the European option. Now what we are saying is calculate using the Black-Scholes model as well, where a strong analytical model is present. Compute the price of this option using the Black-Scholes model also, which means I'll find out all these things. D1, which comes out as log S by X plus r plus sigma squared by 2 times t divided by sigma into square root of t. So my d1 is this, d2 comes as d1 minus sigma times square root of t. So this is my d2, then I'll compute nd1, which is the cumulative normal distribution value associated with d1. Then I compute nd2, which corresponds to t2. And from here I get the price of the call option, which is nothing but the stock price times nd1 minus the present value of the strike price x by e to the power of rt times nd2. This comes out as the price of the call, and the price of the put option comes out as C minus S, using the call put parity, C minus S plus x by e power rt, x by e power rt. So this gives me that the price of the put option computed through the Black-Scholes model. So the European, when I am doing it with the Black-Scholes, coming out to 4.075. So the binomial tree gave 4.31, the Black-Scholes has given 4.07. Now the error between the Black-Scholes and the binomial we are getting as this much. So which works out as 4.07, which came as the Black-Scholes, minus whatever came for the binomial tree model for the value of the put. Now what we say is the revised price for the American, that error I'm going to build it. So 4.48, I add up this error and say that the revised price for this American option is around 4.245. This is what we are calling as the control variate technique. I'm trying to do the accuracy of the pricing associated with an American option, where I am using the same tree to compute both the value of American as well as European. And from there I am estimating the price of the American option. It produces a considerable improvement over the basic tree estimate. We'll find this number 4.245 more and more closer to that of the reality. And this is a very important and interesting mechanism for improving the accuracy. So it is involving the using of the tree to calculate the difference between the European and the American price rather than just looking at the American price alone. Right? Now, I want to know, are there any alternate procedures for constructing the trees? This procedure that we have constructed, the stock tree, is what is called as the CRR based one, Cox-Ross-Rubinstein approach. This is one way people build the tree. But apart from that, we also talk about a few other models where we look at the change in log s rather than s. So we know that a log s will have a mean of something like this, r minus q minus sigma squared by 2 times delta t, and a standard deviation of sigma square root of delta t. So if I have to go with creating a tree of this kind, all I am doing is something of this sort. So probably instead of going and developing the tree like this, an alternative procedure that I want to use, alternative procedure for developing the tree. So we will start with the same stock price itself. Right, I am taking it for the same example just to demonstrate. We'll start with the stock price, but the only advantage here is it's always a 0.5 up and down. So I don't need to compute the P separately, 1 minus P separately. And the up movements will come in this way: e power r minus q minus sigma squared by 2 times delta t plus sigma square root of delta t. So here it comes out as, right, I need to find out the u here. In this case, the u is going to be, I can find out u and t, e to the power of r minus q is not there, minus sigma squared by 2. So the entire thing is in e to the power itself. R minus sigma squared by 2 times delta t plus sigma root delta t. Sigma square root delta t. So this is becoming the up, which is coming out to 1.12. So here you have 1.1224, whereas here you have 1242. Similarly, the down movement comes out as r minus q minus sigma squared by 2 times delta t minus sigma root t. So I can directly copy this formula overall, and I can just put a minus in the between. So I put a minus here, it says the down movement is something around this. Now using these two, I can build the up and down. Right, so this number times the up movement. So I am getting some small change, but of course that is resulting again in the change in the probabilities. I can look at the down movement. So the tree can be constructed even using this kind of a mechanism as well. We'll get small changes. So the whole tree we are constructing will get some small changes, because you could see here 28.06 is the down, whereas here it is 28.3. 89.06 is the up, here we have even 89.81 coming up. Now this is the way we are constructing the stock price. The only difference now is the probability of going up or going down, both are 50% itself. So I could take that and I could use for the computation of the price of the option. But the only difference now is we can't compute the deltas quite comfortably here, right? Because probably the theta cannot be computed quite comfortably, because the stock does not remain the same. So some kind of values, Greek's computation becomes slightly difficult if I am using this kind of a procedure. But even this is one of the procedures that is available for constructing the trees. So we may have to be comfortable even in understanding this procedure as well. Then the another method that has been brought out as an alternative to the binomial tree approach is the construction of trinomial trees. So here we talk about the three movements: up, middle and down. So there is a probability of up movement, probability of middle movement and down. So from here we talk about not two movements, we talk about three movements for each: the up, the mid and the down. And the mid is always the same as the original. So if this is S0, even this is S0, this is S0U, this is S0D. and what it says is the u and d again are related by the same. Instead of up moment e power sigma root t, we say e to the power of sigma into square root of 3 delta t. So those are the small differences that come up. We get a probability. Now for the same, let's try the trinomial tree. So though it is slightly difficult for us to operate, if I have to go with the same concept, right, if I'm going ahead with the trinomial tree concept, alright, so here we are taking the stock price. Now for the next period, we are saying 3 of them. So the first one is saying this is the possible value, which is the mid, the up. So here if I compute the up and the down, the up we are talking of e to the power of square root of e to the power of sigma into square root of 3 delta t. E to the power of sigma into square root of 3 times the delta t. So which is working out that this is the up moment and down is 1 by up. So this is what is going to be the down. So at the end of one period, we are putting this number multiplied by the up to be the up and this number multiplied by the down to be the down moment. So these are the 3 possibilities that are coming up. And we are saying the probability of down moment, we are changing it. We are, okay, the probability of middle, we are directly getting it as 2 by 3. Whereas the probability of up, we are computing it as minus square root of delta t by 12 sigma squared. This is my delta t by 12 times sigma squared minus square root of delta t by 12 times sigma squared r minus sigma squared by 2 r minus sigma squared by 2 plus 1 by 6. So this works out to the probability of an up movement, and the same thing if I do with a plus, I get the probability of a down movement. The whole formula as it is, if I take and I remove this minus square root of stuff, which is 0.17, the summation of it is coming out to 1, and this is what is working out for a probability of up and a down movement. Now we can very well find out the values at each, which means if I am going with this, again I get trees like this, right? So from here I get the price to be as simple as this, and here I am talking about an up movement, so this times this, and here when I am looking at a down movement, this times this, so working out again to 50. Now the same logic again, here it is 50, whereas here it becomes 50 times the down moment, so it comes to 40.93, and again here it comes 40.93 times the down moment, so it can go here. So this is how the tree can get constructed. So at every node we can think of 3 important nodes coming up, with these being the probabilities. So we can use this kind of a procedure with these kind of probabilities to really evaluate the trinomial tree and get the present value of the derivative or the value of the derivative using this trinomial tree kind of an approach. Right, again we have 3 different, so we can find the expected values, work backwards, and that is what will give us the solution using the trinomial tree approach. So we'll find the expected values, we'll find the present value by working backwards node by node to compute the overall value of the option using the trinomial tree mechanism. Right? Now, in case, see till now, whatever we have looked at, whether it is R or Q or sigma, whatever are the variables we have taken till now, we assume that they are constants across. But in reality, throughout the life of the option, we assume that they are all constants. But in reality, they are dependent heavily on the time. And value of these variables between t and t plus delta t, if I assume that they are equal to their forward values at t plus delta t. Now, from there, if I am assuming f of t is the forward with respect, with respect to the interest rate, g of t is a kind of a forward with respect to their dividends. So g of t, if I assume with respect to dividends, and f of t with respect to the risk-free rate of return, then a, earlier we were talking of a is e power r minus q times delta t. Now this r I am making it as a function of t, which is a forward value. G I am making it as a function of t, which is a forward value, times delta t. So a becomes that, which means the probability of up movement comes based on the ft's and gt's, and probability of the down movement also comes as 1 minus the probability of up movement using the similar kind of a mechanism. So if at all my R, Q, RF, they are typically not constants, then I take their function, I substitute it in place of the constant, and I can still continue the same process for doing the valuation of the option. But if I am making the volatility as a function of time rather than making these three R, Q and RF as a function of t is not a big deal. I can still use the binomial model. But if I am making the volatility as a function of t, it becomes very, very difficult. And one way to do that is make the length of each time step, delta t, inversely proportional to the variance during the time step. Inversely proportional to the time. So which means I could see that the variance is coming out as sigma t squared times the t. So for n time steps, if I am taking, for each time step I can take the sigma ti squared times tn, and from there I can actually set the up moment as e to the power of square root of v by n to make it more and more dependent on the time, because this is for each I this is going to change, and based on that I can very well set my u's to be changing at every point. So the u may not be constant, the volatility at each time point, it need not be a constant, it can keep changing at each of the time period. So this is one alternative where I can change the sigma at each point in time. Now that we have understood the binomial tree based model quite comfortably, we move on to the second numerical procedure of this session, which is the Monte Carlo simulation. Even the Monte Carlo simulation goes with the risk neutral valuation itself. Now the difference is we create the whole sample path for each period. We create the sample path. So which means let's say we are talking about a 30-day option. We take the daily prices. We generate the prices for the 30 days using some kind of a generation mechanism, and we find the expected payoffs in a risk neutral world, discount it at the risk free rate. Look at this. Assume that the interest rates are constant. I sample a random path for S. Alright, I sample a random path for S in a risk neutral way. How do I sample it? Either I sample it in this way, where I take for the next period, I take S of t plus delta t. I take it as S of t plus mu times S of t delta t plus sigma times S of t epsilon square root of delta t. Now I take this as the mechanism. Right? I take this as the mechanism. I assume some value of mu. I have to take based on the historical data. I take some value of mu, st, delta t. Similarly, we are going with sigma, st, and we generate the values, find the value of the option, and find the expected value of the various generated stuff. Find the payoff from the derivative. Okay, let me take one example. Did I consider any example here? No. So let me create one example. So let me take a stock price to be 50, right? And this stock is giving on an average, we'll take it as 8% or 10%, or probably we'll use the same example which we have used in the binomial tree, right? Let me use the same example, why not? So whatever the example that I have used in the binomial tree, I'll use the same even for the simulation. Okay, so I'm using, let's say this being my return. So I'll assume that the stock is giving the risk-free rate of return itself, or probably for convenience here, let me take that it is giving around 15% return because it's a risk-free should be 10, so the risky one is giving me around 50 on an average. So let me take that to be the number. And so which means I will create first of all a few, I require something of this sort to be generated. So I'll generate a few random numbers first, right? Basic random numbers. So I'll create a random number using the rand as a formula. Let me assume that I'm generating some 5000 odd random numbers. Alright, I've generated around 5000 random numbers. Now these 5000, I'll convert them into the standard normal values. So wherein I'll take the norms inverse function associated with this probability, arrive at the standard normal values, and once I had the standard normal values, I will have to generate this kind of a mechanism, right? So I'll find the day 1 or day 0. Let me take it, the day 0 price is exactly this. Across the space, I take the day D0 price to be the same. So all the 50 days, for all the scenarios, the day 0, which is the today's price, is 50. Now what I do, okay, let me freeze these values so that they don't keep fluctuating all the time. Alright, so this is my day 0. Now, because we have split the whole time interval into 5, what I'll say is period 1. I'm generating the values using this random. Oh, I can't use the same random number across. So these two really are of not much of a use for me right now. So I'll generate for period 1, period 2, period 3, period 4, period 5. What I'm saying there is for period 1, I'm taking it as 50, which is ST plus mu times ST times delta T. Mu. Now this is annual. Okay, so mu times delta T I have taken, which is making it monthly, times the ST. This is what I am taking as ST. Okay, plus sigma times ST times epsilon times square root of delta T. Sigma times square root of delta T times ST times epsilon. ST times epsilon, I'll directly take the norms inverse of the random directly. I'll take the norms inverse of the random variable directly. So this is saying that the possible price on day 1 is 50.96. Similarly for day 2, day 3, day 4, day 5. So it is generated one kind of a possibility. So it may go to 57, 57, 54, 57. So this is the possibility of the prices it has created for the period 5 using this kind of a mechanism. So I got for all, so I have generated almost 5,000 odd possibilities of the stock price over the next 5 years. 5,000 odd possibilities of the stock price over the next 5 years. So five periods, which is our 5-month period. Okay, so calculate the payoff. So these are the sample a random path per S. I have sampled a random path. Now from here I can find out the payoff from the derivative. Okay, I'll find out the payoff from the derivative, which is nothing but the maximum of the strike price. This is my strike price minus the stock price, comma 0. So I have got the payoff from the derivative. So these are the various payoffs for my derivative. Repeat steps 1 and 2 to get 5,000 sample values and payoffs. We have already got it. 5,000 payoffs is what I have got. Calculate the mean of the sample payoffs. Okay. Mean of sample payoffs. I'll take the average value of these payoffs. I got as 3.73. Discount the expected payoff at the risk-free rate to get an estimate of the value of the derivative. So the value of derivative, I'll discount it to the present value, which is nothing but this divided by e to the power of R. I'll have to do it with the risk-free rate. So let me assume the risk-free rate is 10% times T. Delta T is to be this much. So I get the value of the derivative is around 3.71. And here if I am making my R to be around 10%, I get the mean of this is to be around this and the value of the derivative to be around 4.07 using the binomial tree approach, using the Monte Carlo simulation approach. So this is one way people can use the Monte Carlo simulation. I repeat it, I get different possible. So you see that the value of the derivative to a large extent is around the same. Even if I am changing it a little bit, I am getting different possible values, but the value of the derivative lies to be more or less in the same zone. In some way, I can assume it to be following this kind of a process, whereas in some cases, I can assume it that log S is following with this kind of a mean, which means I could very well go for estimating T plus delta T using this approach, ST times e power mu minus sigma squared by 2 times delta T. So probably if I'm doing it through a second model, right, probably I'll call this as model 2, where I am assuming a kind of a log normal distribution. In that case, if I am going with the same stuff, my day 0 still happens to be the same. I'll generate it over a 5000 days period. Okay, this happens to be my day 0. But from day 1 onwards, what we are doing is st times e to the power of mu minus sigma squared by 2 times delta t, mu minus sigma squared by 2 times delta t plus sigma square root of delta t times epsilon. Sigma square root of delta t times epsilon comes as norms inverse rand. So this happens to be the stock price at the end of day 1 or period 1. Same logic I'll use for the whole 5 periods. These are the generated prices and I get my payoff here. My payoff comes here as out to be any of these values. So from here I can find the mean of sample payoffs comes out to be the average value of this particular term, this payoff 4.27, and from here comes the value of the derivative for me, which is the present value of this. So depending on what is the kind of logic I am using for the stock price movement, I can either use the geometric Brownian motion of this kind of a mechanism or for the log s followed. So any of these finally helping me in terms of generating the stock price tree and from there doing the pricing of the derivative. Looking at the bigger picture, if at all I want to use this derivative or to use this model for valuing the derivatives where payoff depends on the path. This is the whole path. So if someone is saying a derivative, the average of the prices over the last few months, that is what will determine the payoff, like your Asian options. Then the best alternative is the Monte Carlo simulation itself. So if at all any derivative is having a logic where its payoff determined based on the path followed by the variable as well as the final value, then probably it is having a very unique advantage there. And even if the payoff can occur at several times during the life of the option rather than at the end, because I have the whole path with me, I can very well use Monte Carlo simulation to really simulate that outcome. And here I really don't need to bother about a log normal distribution or anything else. Any distribution, any kind of a movement in the process can very well be understood here. That's one more advantage. And if at all the payoff is depending on several variables, not just the stock price, probably if there are variable 1, variable 2, variable 3, all of them acting together to determine the payoff, even then compared to any other analytical or other numerical procedure based approach, Monte Carlo simulation becomes more and more effective. But one thing we have to understand, The main drawback associated with it is computationally it is very time consuming. We require powerful systems, powerful processes to execute it. But the other side, the problem that lies is when there are early exercise opportunities, probably the binomial tree is much better for me to evaluate whether I should exercise the option now or take it to the next period. Whereas the Monte Carlo simulation will not help me in terms of going ahead with that kind of an analysis comfortably. So these two lie to be some of the important drawbacks associated with the model. Nevertheless, for lots of valuations, this becomes one of the powerful procedures to be used. And just to work out how do we use it, in terms of Excel, we have already talked about the usage of norms inverse RAND for getting random sample from a general normal distribution. But if I want it for two correlated distributions, right? Let's say correlated samples, right? If I look at two random numbers, okay, let me generate randoms. Let me generate two set of random numbers. All right, so we'll go with 5,000 of them. All right, then we go with the standard normal, right? So probably I could have taken the norms inverse associated with each one, right? I have created the norms inverse of each one. I take the correlation between the two norms inverses. I take the correlation between the two norms inverses, I get it is very close to 0. But if I know that I have to generate a correlation I want to generate of 0.5. Then what we are doing is we are introducing a slight difference. The first one will remain as it is. The first one will remain as it is. Whereas the second one, I go with this kind of a mechanism. The correlation times the first one plus the second one times square root of 1 minus correlation square. So correlation times the first one plus, or let me take it as correlation times the first one plus square root of 1 minus correlation squared times the second one. So the second one we are altering a little bit, and by doing it, now my random numbers that are coming out are something like this. So instead of these two being my standard normal variates, I'm basing on these two as my standard normal variate. So here the correlation is 0, whereas if I call it as revised correlation, it works out for me. Correlation between this number and this number works out very close to 0.5. So I have generated two random samples normally distributed but with a correlation of 0.5 between them. And if at all I have to do with more number of correlated pairs, we use a process called Cholesky decomposition. What we do is, okay, I take the correlation matrix, okay, 1, 0.9, 0.8, 0.9, 0.8, 1, 1, and probably between 2 and 3, let's say it's 0.7, 0.7. Let's say this is a correlation matrix. Now what I typically do is, we split the stuff. The Cholesky decomposition, what it says is, you split it into an upper triangle and a lower triangle matrix. This is one triangle. This is one triangle, and you take it the other way. A, B, D, 0, C, E, 0, 0, F. Now you do it in this way that so this is an upper triangle, this is a lower triangle matrix. You multiply the stuff and make it equal to this, which means A squared equal to 1, which is working out to be A equal to 1. Then you say AB is equal to 0.9. Right? So A is 1, so B you take it as 0.9. Then AD you are taking as 0.8. So D you take it as 0.8. Similarly, I'll take all the stuff. Right now, AB 0.9, B squared plus C squared, we got it as 1. B squared, we already got it as 0.81. So C squared will come out as 1 minus 0.81, which is 0.19, and from here I get my C, let's say, as 0.4 something. So that is what is my C. So I get all these values. And what I say is, instead of just creating it like this, now I'll say my first value is x1. My second value will go as whatever is the b times x1 plus c times x2. The same logic I'll go with d, e, f. Now, because if you look at the same in a two-dimensional mode, 1, correlation, correlation 1. This is the correlation matrix. So if you look at A0, B, C, if I had created it into a triangular matrix like this, A squared equal to 1, A equal to 1. AB equal to rho, which means B equal to rho. Similarly, AB equal to rho, B squared plus C squared equal to 1. B is nothing but rho squared plus C squared is equal to 1. C has come out as square root of 1 minus rho squared. Now you look at the triangular matrix. A is 1. B, so this is 0. B has become rho, and this has become square root of 1 minus rho squared. Now that's where we have designed the first one, epsilon 1, we have taken as x1 itself. But epsilon 2 we said rho times x1 plus square root of 1 minus rho squared times x2. The same logic will apply for n number of variables as well. You create a kind of a Cholesky decomposition function like this, where you are mapping the correlations with a lower and an upper triangular matrix, and whatever the triangular matrix that you are getting, you generate the random numbers, get the standard normal random variates from that, and you equate it with this kind of a relationship. You can very well find out three or more correlated pairs of variables. And if you are increasing the number of trials, the accuracy is going to increase. So the more and more, if I am taking 5,000 or 10,000 kind of samples, I'm going to increase my accuracy. And what we are mattering is, once I am getting my standard deviation as well as the mean of the discounted payoff, I could very well get the 95% confidence interval for the same, and I can very well find out whatever is the 95% confidence interval for the price of the derivative. The more is the number of samples I am using, I could clearly see that the error is going to be more and more minimum. So the uncertainty about the value of the derivative is inversely proportional to the square root of the number of trials. The higher is the number of trials, the lesser is the uncertainty, and vice versa. The earlier Monte Carlo simulation mechanism that I have talked of is generating the prices across the path. In some cases, I can use even the binomial tree also. The simulation can happen through the binomial tree also. It's like this. For each path, so I know that there are two parent paths that are possible. So what we are simply saying is, we have a binomial tree and the probability of up movement is 0.6 and the down movement is 0.4. Now I generate a random number. Right? If the random number is greater than 0.6, I create an up. If it is less than, or if it is, if it is less than, if it is 0 to zero point 0.6, I create it as an up. And if I am getting 0.6 to 1, I create it as a down. I make the tree either go up, go down accordingly. Like that I get the whole tree up and down, where the probability of going up is something, going down is something. Right? Now the same logic, probably here, if we have computed the up and down, so up and down, I'll take it, let's say, from the binomial model itself. Here we have the up and downs. So I'll take the up and down, let's say, still from the binomial tree itself. What it is saying is, you generate a random number. So binomial tree using simulation, right? If I am looking at day 0, the prices are still the same. So I'll use this as the price. I'll use this as the price. So I'm not generating the whole value here. I'm just showing you the procedure, how we are using the binomial, clubbing it with the binomial tree approach here. Okay, the stock prices are 50. So for the period 1, what I'm going to do is, I'll generate a random number. So if I'll generate a simple random number saying if rand is greater than 0.6. So I'm talking of 0.6 to 1. So I'll take it as a down. I'll take this number and I multiply it with the down factor. Else I'll take this number and I'll multiply it with an up factor. Straightforward. So either up or down. Now what happens is, for each of the periods I am generating this. So either there is an up or there is a down. So like this, only these values come out for my period 5. So if it is greater, I get this. So I have a complete path from the initial node to the end of the tree. Now here we can compute the payoff. The payoffs here come out as the max of strike price minus the stock price, comma 0. So these come out to be the payoffs on the final date. Right, these are the payoffs, and I have a similar procedure to complete more trials. I'm taking the mean and then finding the value. I'm taking the mean and then finding the value of the derivative, again going with this. So here I have to look at, okay, here I have taken 60, but yes, let me take the probability of going up and going down itself so that I can match it comfortably. So the probability of going up, if I am taking as something like this, so I'll alter the question slightly here. I'll alter the calculation slightly here, where I'm taking this to be the probability of up movement. So we are changing this calculation across, which is resulting in I getting the value of this at 4.42. So using this procedure, if I am finding out the value using the, so expected payoff comes out as the average of the payoff column here, and from here I get the value of the derivative as the present value of this expected payoff, e to the power of r t. So this we are getting as 4.21. So this is one more way in which I can very well use the Monte Carlo simulation to find out the expected value of the payoffs, and which can help me in finding out the pricing of the derivative, right? So a few important points about the Monte Carlo simulation. It tends to be numerically more efficient than other procedures, especially when there are 3 or more stochastic variables, because the time that is taken to carry out a Monte Carlo simulation, it increases linearly, whereas for all other procedures I see that there is an exponential increase in the time. So the higher is the number of stochastic variables, I find Monte Carlo simulation being much more effective compared to the other models to be used. And at the same time, we have seen that it provides a standard error for the estimate, 95% confidence intervals of the estimate. All these things I can compute comfortably using the Monte Carlo simulation, and it can accommodate complex payoffs and complex stochastic processes following any kind of a distributions as well. And it can also be used especially when we are looking at the whole path rather than just the end value of the asset. If any kind of a payoff depends on the entire path rather than exclusively the end value, we can still use the Monte Carlo simulation very effectively. But here what we generally see is the computation time is very heavy, and so we can very well look at some kind of procedures for reduction of variance. So we talk about a few of them, one being an antithetic variable technique. So for every derivative I calculate two values. One, the usual way. Two, I change the sign of all the random samples. From the standard normal distribution, if there is a -2, I make it +2 and I simply compute it. And the value of the derivative is calculated as average of F1 and F2. So like this I generate for every pair. I get lesser numbers now, but the accuracy improves much better, because we are talking about the average between the negative as well as the positive. Average of the F's is what is giving me the final estimate. From there I can find the standard deviation, and what is observed is, in that case, the standard error or the 95% confidence interval is in a very narrow range, and that is what we call as the antithetic variable technique. Similarly, we can use a control variate technique, which I have already used in case of pricing between the American and the European options. So when there are two similar derivatives A and B, for derivative A, right, American and the European options, I have used the valuation for derivative A and B, both of them, and derivative B, I'll choose the one that is having an analytical solution. And from there, I look at the gap between the analytical solution and the simulation one. That gap, I adjust it to the simulation example that I got in for the other derivative, and I make it as the improvised or the revised value of the derivative, which will improve the solution quite drastically. That is what is the control variate technique. And the third way which we can look at is the importance sampling, where I will not choose all the paths, I choose only the important paths. Right? And probably, let's say if I am going with the out of the money OTM option, I know that very few values, See, if I'm going with a regular way of generating the prices, almost 90%, 95% of the prices are going to be going to result in a payoff of zero itself. So the more and more I'm making it zeros, it becomes a waste of time. So I'll try to choose only those important points. So when I'm saying F is the unconditional probability distribution for the stock price, I will look at the probability of the stock price greater than K and try to generate. So I'm looking at Q as the probability that the stock price crosses the strike price. Probably it is 2% or 3%. Then what we are saying is I'm going with G, which is nothing but F by Q, which talks about the probability distribution of the stock price conditionally that it is greater than K. And we generate the samples only for G rather than the whole of the original distribution. And from there we find out the payoff and we multiply it by Q to go back to the original data. So sometimes to simplify the computation procedure, we can use even the importance sampling as well. Similarly, we can follow the stratified sampling, where rather than going for completely random kind of a generation, we split the whole data into equal likely intervals and we take one representative from each interval and we try to do the value of the derivative through that approach. It again reduces my computation time quite drastically. Similarly, I could even follow a procedure called moment matching, which is otherwise called as quadratic resampling. So first we take the samples from a standardized normal distribution, but there the clause is I make them match with the higher moments as well as mean and variance. Let's say I have taken a random sample. Okay, I have taken some random sample generated from a standard normal distribution. I have used this formula to generate, right? I have generated a random sample like this. But what is happening is when I generate it like this and I try finding out, okay, let me just copy paste it. I try finding out the mean of this. It's not exactly 0, it's 0.013. And I try finding the standard deviation of this. Again, even this is not 1. This is around 0.99. What we are saying is we are adjusting it by subtracting the mean and dividing it by the standard deviation of the data. So we are adjusting this random sample in this way by subtracting the mean and dividing it by the standard deviation. And this is what we are taking as the random sample. The reason being, now this will give me a mean equal to 0 as well as the standard deviation equal to 1. We are matching the moments. We are adjusting the samples to get a correct mean of 0 and a correct standard deviation of 1. And we are using this adjusted sample for all the calculations rather than the original sample. But of course, it saves the computation time. But the problem is it leads to a memory problem because every day, this is the one, I have done it for one day, one period. I may have to do this for several periods to finally find the payoff at the end of the teeth period. So the memory becomes a big problem here, but the computation time is reduced quite drastically. So this is one more procedure where I can reduce my computation time in a Monte Carlo simulation approach. And we can even talk about using quasi-random sequences, otherwise called as a low discrepancy sequence. So again, we are taking from a probability distribution, we are sampling a sequence of random, and it is having a desirable property that the square root that the standard error is proportional to 1 by m, not 1 by square root of m. So which means with a less number of observations, I can reduce the interval quite drastically. So it's much more flexible than the stratified, and this is one mechanism which is very much used in the industry to reduce the computation time in case of a Monte Carlo simulation, right? Now the third important numerical procedure that we can look at for finding out the value of the derivative is the mechanism of finite difference methods. What we do is we value the derivative by solving the differential equation that is satisfied by the derivative. Now we know that this is the differential equation, and only if this kind of a differential equation is satisfied by the derivative, which is nothing but the payoff of the derivative with respect to time, payoff of the derivative with respect to the price times price times r minus q, half sigma squared s squared, the second derivative of the price of the derivative with respect to the underlying price. This should be equal to r times f. The proof for this, the Black-Scholes differential equation, we have established it in our earlier content. Now this differential equation, I convert it into difference equations like, okay, delta f by delta t. So I look at it at, for a small change in delta t, what is the change in the price of the derivative? Similarly, delta s. Now what do we do is the process, look at it. We divide the life of the option t into n equally spaced intervals of length delta t. Now let me use this. If I have to talk about the finite difference methods, right, let me take the same numbers. So here, let's say these are the numbers. What we are saying is the life of the option, this is the life. I split it into the equally spaced intervals. Now let's say delta t, or probably let me say number of intervals. Let me call it as 20. Right, I split the life of the option into equally spaced intervals, which is 20. So which means that delta t here for me comes out to be this divided by this. So I start with the t. So I start with the t here, let's say 0, and from here it goes up. So 0 plus this. So the time periods go like this, right? So up to the time period 0.41, I am going the same way. Alright, so up to the time period 0.41, we have split it up. So these are the delta t's, 0, delta t, 2 delta t. So this is 0, delta t, 2 delta t. This is what we have split. Similarly, I take some maximum value, the stock price, where the value of the put literally has no value. So let me say S max is the maximum stock price where the put is literally of no use. So if I say 80, if the stock price is 80, then I'm saying that this put option will not have any kind of a value. Approximately I'm taking some S max stock price that is sufficiently high that the put virtually has no value there. And from there, I'm considering again the number of intervals for S. So here I say, let's say I'm going with 10 intervals. So then here we are saying delta S this time. I'm taking delta S, which is nothing but S max divided by the number of intervals here. So I got it as something like this. So here I'll be taking S on this side, which is 0, 0 plus I take the delta. So 0, 8, 16, 24, I take it up to the max. So I get a kind of a table like this. The level of S max is chosen that one of these is the current stock price. So probably let make it one value should be somewhere around 50. So probably let me make this S max, let me take it 100. Then I'm taking these numbers as 0, 10 up to 100. So I'm defining it as one of the stock price. And the time points and the stock points grid. Now I have 11 here, 21 here. So those many points are what I'm coming up. I plus I comma j corresponds to I delta t. So if I'm saying this point, it is nothing but 3 delta t in term and probably a delta s. That is what is the price that is corresponding. So stock price of 10 and a strike price and a time period of 3 delta t. Then we are defining a few important definitions here. Forward difference approximation, what we are saying there in a forward difference approximation is when I am talking of delta f by dou s, it is nothing but f I j plus 1. F I is associated with the time. F I j plus 1 minus f I j. So the value of the derivative, the difference in the values between these two divided by delta s, which is this two. This is what is coming out to dou f by dou s. In a forward, I am looking at for the next period and based on that I am finding out the difference. Whereas when I am going with the backward, I am looking at the current and the previous. So at this point, if I want to know the current and the previous divided by these two. And symmetrical if I am taking, so I am looking at this minus this divided by this minus this for the value of the derivative here. So this is a symmetrical approximation. Now first of all, that is with respect to the stock, dou f by dou s. If I want it for dou f by dou t, I'll take I comma t, I comma s, I plus 1 comma s. So these are the two time periods I am taking. I plus 1 comma j minus fij divided by delta t. Delta t is the difference between these two. Similarly, when I am talking about dou squared, which is towards that gamma component, I am taking it as I and j plus 1 minus 2 times fij divided by delta s squared. Now you could substitute these values in the differential equation which we have got earlier. Dou f by dou t, let me write it, dou f by dou t plus r minus s, r minus q s dou f by dou s plus half sigma squared s squared dou squared f by dou s squared should be equal to r, should be equal to rf. Now this is where we are bringing in dou f by dou t is f I plus 1 comma j minus f I j divided by delta t plus r minus q. So that is what we are bringing in here. fi plus r minus q j times delta s, r minus q j times delta s, f I plus j minus I comma j plus 1 minus f I comma j s minus 1 by 2 delta s, half sigma squared j squared delta s squared, this part is equal to r f I j. Now if I simplify it, I get something like this: aj times fi comma j minus 1 plus bj times fij plus cj times fi comma j plus 1. Now you see j minus 1, j and j plus 1. So at this particular point I, at a particular time I, we are taking the three prices j minus 1, j and j plus 1, and that is what is giving me. So it's like this: j minus 1, j plus 1. These three of them are giving me the value that is corresponding to this. These three values are giving me the value corresponding to I plus 1 comma j. And how are we getting this aj? Half r minus q, if you simplify this, that is what is coming out: half r minus q j sigma delta t minus half sigma squared j squared delta t. Now j is known, delta t is known, sigma squared is known, r minus q is known, j is known. All these values a, b, c are known. This is an implicit finite difference method. So we are getting finally aj times this, bj times this, cj times this, which means at the end I am having m minus 1 simultaneous equations that can be solved for m minus 1 unknown. So that is, once I solve that, I am getting each value of fn minus 1 j. Right, finally I am getting using this, I am getting so many different simultaneous equations are what are coming out. Right, so I am solving all the n minus 1 differential equations and getting m minus 1 values of fn minus 1 comma j, and each one is compared with k minus delta js. So if it is early exercise at time t minus delta t is optimal, then it is set equal to k minus j delta s. So this is a very robust procedure, but the disadvantage is I have to go ahead working into m minus 1 simultaneous equation, which would result in a very heavy pain. But solution does exist through this kind of a method. And slightly a variation from an implicit finite difference method is an explicit finite difference method, where I am making an assumption dou f by dou s and dou squared f by dou s squared are assumed to be the same for I comma j as well as I plus 1 comma j, at least for two adjacent points. Dou f by dou s and dou squared f by dou s squared, I am assuming them to be the same. Then we are getting a slightly different expression. Again, doing the same part, all we are getting is fij comes out to be based on fi plus 1 j minus 1, fi plus 1 j, fi plus 1 j plus 1. So what we are getting is the current price, the current value of the derivative is actually coming out from three different values of the next period. So that's where we are calling this kind as an explicit. So just to simplify between implicit and explicit, I comma j plus 1, I comma j minus 1, all three put together are helping me determine I plus 1 comma j for the next period. All these three are the inputs. Whereas in an explicit method, just one input for the current is giving me the possibilities of three outputs for the next period. So that is what is coming out in an explicit finite difference method. And this method can even be used quite comfortably when we are doing a changing of the variable as well. The same procedure, you have a new differential equation, it gets changed into a new difference equation, you work it out again in the same manner to solve the n simultaneous equations, n minus 1 simultaneous equations in n minus 1 unknown, and which can take you into the computation of the value of the derivative. The same, there also you could use an implicit method or an explicit method. The assumption remains the same for the explicit method. The major application wise, if I am going ahead with the same type of derivative problems as that of the tree, I can use the finite difference approximation. The major thing is, if the payoff is depending on the past history, this plays a very important role like a Monte Carlo simulation. But of course, it increases my computation time because I have to create a big grid, and delta, gamma, theta can quite comfortably be computed from the Fij values that I have on the grid. So these are the three various mechanisms that we have looked at. The binomial trees, had a good understanding on the binomial trees for options on indices, currencies, futures. Looked at the how we will tweak the binomial model for a dividend paying stock. What are the alternative procedures for constructing the binomial trees? How do I look at the time dependent parameters, especially for R, Q, RF and sigma? Then apart from binomial trees, we focused at decent extent on Monte Carlo simulation and the variance reduction procedures associated with saving the computation time in a Monte Carlo simulation. And the third important method, the finite difference method for finding the value of the derivative. Though it's a complex method, it depends on n minus 1 simultaneous equation to solve the value of the derivative. So it goes with an iterative kind of a procedure. Alright. So that is what I wanted to convey as a part of this particular session. Thanks a lot.